Good morning, everybody. My name is Ryan Hughes. I'm Head of Active Portfolios here at AJ Bell. And today in this short webinar, we just wanted to talk through where are markets now in respect of coronavirus, of COVID-19, and where things have gone over the last few months. So just a quick run through what I'll talk through over the next 20 to 30 minutes. So it's a quick introduction to AJ Bell Investments. We're always aware that there are new people dialing into our webinars all of the time, and you're all very, very welcome. And so a quick introduction to the investment part of our business. And then I'll talk through just at a high level what's been happening in global markets. I'll touch a little bit on the Federal Reserve and some quite interesting announcements that have come out in the last week. As well as various other points around, we'll look around various global markets. I also wanted to touch on commercial property and what now. Obviously very topical given I'm sat here recording this webinar from my home office rather than my normal office. And then at the end, I'll just try and sum up a little bit as a little bit of an outlook as to where we think things might go over the next couple of months, but there are so many variables out there that is a real challenge. So we'll try, we'll do our best, and hopefully you'll find the next 20 to 30 minutes interesting. So just as an introduction, AJ Bell Investments, as a reminder for some of you, this was launched in 2016. We are here to build and manage investment solutions. We are delighted to say that we're already managing over £800 million now of clients' money, which is fantastic, and thank you to all of you that have been supporting us through that journey. We are through our 3-year track record on our passive NPS strategies, our oldest strategies, as well as having a wide range of other investment solutions there as well, passive and active, both on growth and income. The ingeniously titled Pactive, which is a beautiful marriage of both passive and active investing. And we also have some passive funds for those of you that prefer the collective rather than the NPS, some income funds, which is a mix of passive and active strategies, and also something called our retirement portfolio solution. All in all, we have lots and lots of things going on in the investment business, lots of different products to talk to you about, and any one of the AJ Bell team would be delighted to talk to you about those. So I won't dwell on those any longer. Let's get into the nub of today's question, which is about where are we now in global markets. And I just wanted to start just by setting the scene really with a range of indices of different global markets, both equity and bonds around the world, just looking at what returns have been like year to date. Now I think if we were sat here having this conversation around 6 months ago, when the world was well and truly let's say the global markets were in the grip of panic around coronavirus. I think it's fair to say right now that the world is very much still in the grip of coronavirus with the sheer number of cases that are happening around the world. If we'd had this conversation 6 months ago, I think we would have been absolutely staggered if we thought, winding the clock forward 6 months, that numerous equity markets, nearly all equity markets, would be in positive territory year to date. And that's exactly what we're seeing. Now I should say these are in sterling terms, so overseas returns have been helped over this picture by a weakness in sterling, albeit I'll come back to that shortly. But we've got the S&P 500 up nearly 10% year to date. We've got Asia up 6.5%. We've got global bonds up nearly 6%. We've got gilts up 5%. Now, okay, maybe some of those returns in gilts, given the fear and the panic that was happening 6 months ago, can well and truly have been expected. But I think we would all sit here quite surprised to think that equities, and there we've got the MSCI World, up 5% in sterling terms year to date. Now, bearing in mind that we were off around 20% at one stage, just shows the sheer strength of the recovery. I think what is interesting there, right at the bottom, is the FTSE All-Share as a truly lagging market, and significantly lagging market now, down 18%. Now, obviously, of course, doesn't get the benefit of any sterling weakness to drive those overseas returns, but is actually, I think, quite telling in terms of the structure of the UK market. And actually, we've been very recently having a call with a Chinese manager and we were talking through the relative differences between the structure of the index in Asia and China versus the structure of the index in the UK. One very focused on what we could maybe term the new economy, so those types of companies that benefit from a coronavirus type environment where we travel less, perhaps our leisure time is less or is very different. And then FTSE All Share, which is obviously full of financials, is full of oil stocks, is a very different type of index there. And you can see why those types of companies are not responding to a recovery, to economic stimulus in the same way as the S&P 500, for example. So very different types of index and structure of the index are meaning very different types of returns there, as different sectors respond differently to the economic environment. And of course, that's best exemplified probably by BP and Shell over the last 6 months, where we've gone through a period of actually seeing negative oil prices at one stage, and a significant collapse in the oil price, and therefore a significant collapse in the performance and the price of those big oil majors that make up a relatively large part of the UK market. And you can begin to see why the UK market has been lagging other markets. And again, we'll take a little bit of a deeper look at the S&P 500 in just a second. Now, in fixed interest assets here, again, quite a broad spread. It perhaps wouldn't be too much of a surprise to think that that sterling high yield bonds are lagging there, given the higher risk involved and given the focus on translated into sterling. But sterling corporate bonds, they're having a nice positive return, as gilts, as we said, delivering well as yields have really compressed in, albeit yields are very, very volatile in the government bond market at the moment. And we'll look, and I'll talk through the impact in the US in a couple of slides' time. So let's just take a closer look maybe at the S&P 500. I mean, this is, as ever, been the driving force of market returns over the last, well, year to date, but clearly since the bottom of the market in March and around mid-March. And we've seen phenomenal returns from parts of the US market, and I deliberately say parts of the US market there. It has been what feels like a relatively narrow-based market driven by the technology sector, but clearly some other stocks have performed very strongly as well, and it hasn't been confined only to those large caps, but they have played a very important part in driving the index higher here. But when you look outside of the S&P 500, we've also seen strong performance from US small caps, as well as some of the oil stocks in the US recovering. And this has really been driven by huge amounts of stimulus thrown at the markets by the Federal Reserve and the US government, of course, trying to keep employment going as best they can. And so far, it seems to be that investors are buying it. That they seem to think that that those noises made by the Fed, that those noises made by governments, pretty much around the world, to be honest, but particularly in the US, will be enough to keep equity markets high and at these elevated levels. Now, clearly, that has an impact on valuations, and I think it would be remiss of me to not mention that some of the valuations of some stocks on a PE basis are very high, and we are seeing markets pretty much around the world hit all-time highs. And as we said on the previous slide, that really is something that would be impossible to comprehend only 6 months ago. So there are strange things happening out there in the world, and perhaps in the next couple of slides we can identify a couple of what those things are and why they're driving markets higher. So I've just alluded to technology there has been a driving force in pushing the US market ahead. And on the left-hand side here, well, the title is entitled "FAANG You Very Much," so apologies for the play on words there, but I think it really is actually quite pertinent to what is going on in the US market. And that is a very clear shift that's been happening over the last couple of years, but has certainly accelerated over the last couple of months in the amount, the weight in the index that these major technology stocks are playing. Now, of course, they're not all classified as technology stocks anymore, given the way that technology has been reclassified into some elements of consumer. But clearly, this is a major driver in markets over the last few months, and as it's almost been a kind of self-fulfilling role. As these stocks have been getting bigger, they have been driving the market higher. And actually, if you looked roughly year to date, and you excluded these 5 stocks from the S&P 500 return, the S&P 500 would actually pretty much be in negative territory. So the other 495 stocks have really gone nowhere. But these 5 stocks have performed so strongly that they've dragged the S&P 500 into a positive return of around 10%, as we saw on the last couple of slides. And so that is a major driving force for returns. And ultimately, it's a major driving force for whether active fund managers have done well or done badly. If you've been managed to be overweight these types of stocks, then you perform well, and if you've been underweight, you have performed poorly. And it really has been pretty much as binary as that when you compare managers' performance to the S&P 500. Now, some of these stocks are sitting on some pretty full PE valuations, as I said, and are certainly stretched to a level that some people may find uncomfortable. Now, I think that's perhaps well exemplified by the chart on the right-hand side, which is the chart of Tesla. So here I put in the long-term chart of Tesla's share price since launch. So we are looking at a decade now that Tesla's been going, and we can see what can really be described as spectacular performance since the bottom of the market in March. So the Tesla share price fell to about where are we there? About just over $300 in March, and has rallied to actually well over $2,000 now. Well, in fact, as I say now, it recently announced a stock split, and the share price is now around $450, as they wanted to bring that price down to make it more appealing to investors. Now, what's really interesting when Tesla announced that stock split, now bearing in mind the valuation of your holding does not change in a stock split. Well, on the day of that announcement, Tesla rallied about 15%, and also then on the day of the stock split, Tesla rallied another 12%. Now, as I said, the valuation of your holding is unchanged in the stock split, so there is no reason for this value to rally other than people found the value more attractive and wanted to buy in at what they perceive to be a lower share price, even though the company is valued at exactly the same. So who am I to talk about the efficient market hypothesis when we see investor behavior like that? But it certainly is an interesting time for investors, and Tesla is really a share price that is defying gravity right now, and of course it's the largest car maker by market cap in the world, and is doing some amazing technological things as the world moves away from fossil fuel powered cars and to the electric side of things. And obviously some active managers, some very high profile active managers like Baillie Gifford have been big beneficiaries of that. So what about the Fed? Well, last week at the end of August, the Fed made a really important announcement. So Jerome Powell here, now I don't think this is him praying that his policies work, but it is clearly the Fed is very hopeful that its range of measures does enough to support the US economy to get it through this period of weakness. And the key change is in the way that the inflation targeting is being articulated. So the Fed has announced that inflation will be allowed to increase to support the economy. And a very subtle difference, some may say, but an important difference, is that the target has shifted from an absolute 2% target to an average inflation rate of 2% over the long run. Now, what that means is Jerome Powell made it very clear that the Fed would be comfortable if inflation went above 2% for certain periods, and that historically, where we would have expected the Fed to raise interest rates to bring and we've raised them pretty quickly to bring that inflation back to target, is that they've announced that they'll be comfortable with that inflation rate running above target for a period of time. Now, there's also been, in the wording of the speech, an increased emphasis on maximising sustainable employment, and also in the wording specified specifically around lower wage employment. And this is really, really interesting. Again, shift, so a focus on employment, a focus on lower wage jobs, and making sure that there is sufficient jobs in the economy to support those lower income families, and also to have this inflation targeting and allow it to run a little bit above average. Now, these are what in many respects could easily be dismissed as small changes, but they have quite a marked impact on economic policy, and also the way that the market and investors interpret that economic policy. Ultimately, I think we can conclude from those changes in rhetoric that that interest rates are likely to stay lower for even longer, because we are waiting for inflation. The Fed will be comfortable with inflation running high, so they won't be quick to increase rates from this low level should inflation pick up. So really, really important changes from the Fed that could have some far-reaching impacts on asset classes and markets. And if we look at that, what impact we have, well, what we see is that inflation will be potentially beneficial for certain asset classes. Now, historically, this would have meant that commodities would benefit from higher inflation, and of course, we're already seeing the gold price go through $2,000. It's dipped back below that at the time of this recording, but is hovering around that point, and we could certainly see inflation be positive for things like gold, as investors look to find assets that have a store of value. Now, clearly, we have already seen the gold price increase from about $1,000 a decade ago to $2,000 today, and this is before the Fed has shifted its policy. So we watch with interest what happens to gold and other precious metal prices now that the Fed has made this statement. Another area of interest will be index-linked bonds, of course, given their natural inflation linking, so in TIPS as they are in the US. So those inflation-linked assets there that could well benefit from periods of higher inflation there. So that, again, I think people will be looking at that with interest, and with yields where they are. Again, the importance of the ability to maintain purchasing power of your investment. Something that's been a key theme for the last decade. We've talked about this again and again and again over the last decade. In pretty much every presentation I've done for 10 years, we've talked about this type of thing. So index-linked bonds could benefit, and of course equities. And that becomes a very interesting point of view when we just said on the previous slide, or the previous two slides, that equities are at record highs in a lot of markets, and we're now saying that the Federal Reserve is creating an environment that could be very beneficial for equities. So certainly possible that equities could drive even higher from here. And of course, there are subsets of equities. Now, we said equities in general, but there are subsets of equities that could benefit from higher inflation. Infrastructure would be one area where some of those contracts are linked to inflation-like returns. And so if inflation's allowed to run higher, then the earning potential of infrastructure assets could easily increase. And of course, we've talked about technology before, and different parts of those markets. There are also other parts, of course, that could easily suffer as well. But companies with pricing power and the ability to squeeze through inflation-like returns from their pricing could easily benefit over the long run in an environment of higher inflation. Now, as I just said, inflation rates are likely to stay lower for even longer, and we've seen low rates for the last decade now, or more than a decade now. And of course, that could be positive for credit spreads. What we're seeing is low interest rates, low yields on government bonds, but we are seeing a pickup in yield on investment grade bonds, and that is something that that could certainly be interesting for the future as investors look to take a little bit extra risk to generate a little bit extra return in yield. Now, of course, what's also happening in the fixed interest market is that there is some artificial, in some respects, an artificial market right now with central banks directly buying bonds and keeping yields low there. So certainly a lot of moving parts in the fixed interest market, as there ever is. But I think when you get central banks involved in directly owning bonds, again, then that has the potential to create an artificial market. I think is probably the best way I would describe that. I think what we're also likely to see is a steepening of the yield curve, and in some respects that's already been happening. You've seen the longer dated US bonds, the yields on those moved out quite sharply over the last couple of weeks as it became clear that the Fed was looking to happy to run inflation at a higher rate, and maybe that means that yes, yields are lower for longer for now, but I think ultimately what the market's interpreting is that at some point down the line they have to be higher, and it's something we've been saying for a while. So we would expect to see a steepening of the yield curve from here as well. So also some interesting news going on in Japan, where Shinzo Abe has had to sadly resign due to ill health. And he was absolutely, it was interesting, Japan's longest serving prime minister. He served for 8 years. In the history of Japan, there's been a constant turnover of prime ministers. And that's something that where Abe has really brought some political stability to the market, which has been, I think, well received. If you look at the returns of Japanese equities over the last decade, then really they've been second best compared just behind the US. So Japan has recovered very strongly as the policy of Abenomics has been very positively received. Now, of course, now we're in that period of the unknown. Abe will continue until a successor has been appointed, but we don't know who that will be at the time of this recording. I mean, clearly, investors will hope that this economic reform continues. I think what's interesting when you peel back the layers of what's been happening in Japan is we've seen lots of aggressive intervention from the Bank of Japan. They've been buying Japanese ETFs to keep the equity market moving. They've been buying bonds, but the structural reforms that Abe has always talked about, the kind of social, structural, labour market reforms, never really materialised in the way that lots of investors had hoped, and that's something I think that ultimately perhaps held back those returns in the market. So investors will be looking for the replacement for Abe to be pro-market, to look to continue this reform agenda there. But until we get some certainty on that, the market will remain, I think, a little bit volatile. Equity sold off quite sharply on the news, while bond spreads widened there. Obviously, investors hate uncertainty, and given the political stability importance in Japan, particularly with what's going on in China and tensions there and trade tensions around the world, that will become very, very important. So, as I sit here recording this from home, and apologies if you do hear some noise outside on the microphone, I can hear some workmen as I'm doing this. I hope this doesn't get picked up in the background. We come to a slide we've entitled here, The Death of the Office. It's a question mark. Now, I'm sure lots of you listening have also not been to the office at all or much over the last 6 months. And clearly, coronavirus has changed the way we think about working. And it seems to be, when we look at different companies, that home working in some form will become the norm over time. We've seen recent announcements of Schroders, of JP Morgan, and the lawyers Linkletters who all operate out of London, all saying that their new policy is that people won't return to their office on a full-time basis. Now, they're not the first, and they won't be the last, and clearly this has profound impacts on city centres, not just from an office perspective, but also from a social and a retail perspective. Now, I work in London on a normal basis, and I'm sure many of you will know and have been to London. at 5 o'clock, the pubs, bars and restaurants are absolutely heaving. Not even to mention train travel, bus travel and so on. All of this expenditure has essentially stopped and could well stop on a long-term basis. Now, I'm sure those of you working at home are not piling out to the pub 3 nights a week for a pint with your colleagues and meeting up in a way that you may have done when you worked in an office in a city or town centre. So the kind of spending pattern, the social trend, the retail trend, buying a sandwich from your sandwich shop 5 days a week when you're in the office, all these things have a major impact on spending in the UK. And ultimately, these have an impact on commercial property valuations. Commercial property valuations are a function of the rental value that they can get over time. And if those pubs, bars, shops, restaurants, offices are not going to be generating the same amount of revenue, then the value of the property is likely to fall. And is particularly impacted on travel and leisure, as we've just mentioned. So these are, we're only really just beginning to digest the impact on property valuations. Is it the death of the office? I think that's, as a statement, is going quite far, because I think people will be in the office in some way, shape or form, but maybe not on a 5-day-a-week basis, but there will still be people working in offices, clearly. But this is not really filtered into commercial property valuations yet. You're seeing a slow adjustment in property market. As there's not really many transactions, then there's not a lot for the valuers to go on. They need transactional volume to increase to give them some certainty, and then we'll start to see the real impact of the change in these valuations. Now, I've just put one throwaway point at the bottom there, new rules proposed by the FCA on dealing frequency. I couldn't really talk about commercial property as an update without talking about this. So the FCA is putting forward that they want to essentially align dealing frequency with the liquidity of the underlying, and the proposal being, or the consultation being, that they would look to move physical property funds to a 90-day dealing cycle. So that is what you can sell, put your sell order in, but you won't get your money for 90 days. Now, clearly this has profound impacts for the commercial property fund industry. It's actually something, if you've heard my webinars or read any of my articles or press comments, something we've been talking about a long time, saying that this mismatch between the dealing cycle and liquidity underlying is a recipe for disaster. We've seen it time and again over the last decade, with property funds being suspended 3 times if we go back to 2007. They suspended before the financial crisis, for those of you who've been working as long as I have, in 2016 with Brexit, and again now. And ultimately, each suspension undermines investor confidence. So we will see the outcome of this consultation, but I think the FCA made it very clear in their statement, in their paper, that the status quo is not really an option. And so this will have big impacts on property funds that are, of course, all currently suspended, but will need to unsuspend when they get some certainty on the valuations, and that definitely will cause some issues then, I think, as people look to get out of commercial property funds before these new rules come into place, which won't incidentally be for a while, but I think people will like to get out before that. So where next? Where are we as we come to the end? Try and bring this to a conclusion, this quick run through as a conclusion. I think what's really clear is that the economic data is only really beginning to show the impact of the global shutdown. And lots of economic data is obviously a lagging indicator as to what's going on in markets. Now, yes, there are certainly good signs of recovery in lots of markets, and that's great, but unemployment is only really starting to pick up. The associated knock-on from unemployment becomes quite important. If you think about the UK with the furlough scheme, that has really had a delayed impact on the unemployment figures, and we could easily see those pick up. And then when unemployment figures go up, then the government's benefit bill goes up, their tax take goes down, and you get that kind of double whammy on public finances. And of course, spending goes down as well, as people who haven't got a job aren't out spending money in the same way that they would normally be. So this will take a little bit of time to come through. there, but we are starting to see that impact now. As I mentioned before, central banks are buying bonds directly. It's keeping yields low, and this is effectively creating an artificial market. I don't see that changing anytime soon. While we're in this uncertain situation, while these risks persist, we fully expect central banks to keep buying bonds directly. And of course, that has impacts on keeping companies that would normally go bust in the normal routine of capitalism, where bad companies get forced out of business, good companies get stronger. Low interest rates has the ability for the weaker companies to refinance and keep them alive. And so it does have quite interesting impact on long-term structure of economic markets. Equity valuations are high. We've said they remain high. This is quite skewed into a very narrow set of companies. We looked at the 5 in the US versus the 495. Yeah, and that's true if you look at China, if you look at the likes of Alibaba and Tencent and the percentage that they make up of a market, then this becomes a big issue that the narrowness of the market is quite skewed right now. Now, in theory, that creates some great opportunity for active managers to pick up some fantastic businesses outside of those largest companies on lower valuations. But while we get this narrow market and it continues to persist, that creates a challenging environment. Now, when we see that market leadership change, well, I think then we'll be looking for managers who are positioned away from those big market leaders to start benefiting from that recovery. But there's no sign of it yet. Now, I've gone through the last half an hour without even mentioning other major issues that could impact the market going forward. We've got Brexit, of course, and we've only got about 8 weeks before Europe said it wanted an agreed deal in place so that companies could ratify it before year end. That doesn't look likely right now, with negotiations going on and lots of arguments over fishing and other things. It seems an agreement seems a little way away, but we know the EU has got a habit of coming up with last-minute deals. We've got trade wars, the US and China, and that's interlinked with the US election. It certainly plays to the strengths of both US election candidates that they have a strong anti-China rhetoric as we run into the election there, and that I'm sure that will continue to be the case. So trade wars are very much a live issue, as is the US election. Will it be Biden? Will it be Trump? Biden at the time of this recording is leading in the polls, but equally Hillary Clinton was leading in the polls at about this time last time round. So a lot can happen, and we don't know what that'll do to markets. But those 3 issues on the screen there are 3 major uncertainties that certainly have the potential to create lots and lots of market volatility, both in equities and in fixed interest and currency. If we remember back in Brexit and all the things that have gone on over the last couple of years, currency was really the first place that these major impacts got magnified the most. And so I would suggest that anyone who wants to keep a very close abreast of what's going on in economies looks at currency levels to see how they are moving and see how currency markets are interpreting this. So that was just a run through markets. As I said, I just wanted to finish on just one quick reminder. Really, you may have seen emails from AJ Bell or indeed talked to any of my colleagues regarding something called Fundamentals. Well, Fundamentals is live on the Investcentre website, and this is where we give you. We're looking to help you with your research process, your fund research process, and this is where we give you access to some of our thoughts and the investment research team, both on an active side and a passive side, on some interesting funds that we think have got an ability to achieve their investment objective here. And I've given you just a few screen grabs of what you can see. So at the top there, you can see the Artemis US Select Fund, a very high quality, in our view, US equity manager with Cormac Weldon. And you can see there, they'll tell you why we've selected that fund as on our fundamentals list, what its objective is, how it's performed, what its charges are, and you can produce that into a report. And you can see on the bottom left-hand side, there's a 1-page front sheet which tells you about the fund, some performance metrics, its top 10 holdings, all kinds of information. And on the right-hand side there, I've given you just a different example to show you another fund that's there. When we meet the managers, we will update these reports with a short manager meeting note to tell you what the manager's been talking to us about, and really give you an insight into our thinking and help you access managers in a way that perhaps you're not normally able to. Maybe you're not in a position to talk to Cormac at Artemis or Ben at Polar, running those funds there, to get access and insights into their thinking. Well, Fundamentals is designed to help you do that. So I'm not going to go through it all today. There's a webinar I've put together online which talks you through it in more detail. Have a look online, have a play around, see what you think, and all feedback is welcome. So do talk to your usual AJ Bell representative. So that leads me just to finish off, just to say thank you very much for your time today. That's really appreciated for listening to this. If you do have any questions on any of the content or any of our AJ Bell Investments products, we would be delighted to hear from you, and I look forward to speaking to you again soon. Thank you very much for listening.